Good morning, everybody, and welcome to this Q3 presentation of Hafnia, and especially welcome to you, Michael Skov, CEO of Hafnia. You're with us from Singapore today. You can see that in the background, so welcome. And let's have a 30-minute conversation about the Q3. Welcome to everybody who's listening in. You have the opportunity to ask questions in the feed. I will simply take them one by one in the end or when it's appropriate, but please put them in the chat and then you will make sure that they are all done. So welcome to this Q3, and let's start, Michael, by taking into the overview of the Q3, and then we'll take a few more things as we go. Welcome.
Thank you. Yeah, so as you can see here from the key highlights on the slide, the third quarter was another very strong quarter for Hafnia, undoubtedly, and with a result net earnings of $215.6 million and a dividend payout of $194.1 million. I think it was again one of these quarters where we have to say that performance-wise, it's been one of the best that we've seen. And the first 9 months of this year has now proven to be the best 9 months in the history of Hafnia. So absolutely very happy with that result on an isolated basis.
Cool. And then let's take some of the new stuff in the Q3 report where there's quite a few highlights. Maybe we should take this slide first.
Yeah, so for those that are not too familiar with Hafnia and our dividend policy, we had basically decided a while ago to link the dividend policy with our net loan to value, so that we in a way related the payout of dividends to how we slowly but surely would reduce the net loan to value in Hafnia. And for this quarter, we managed to break 20%. So below 20%, it means that there will be a 90% payout of the net profit for this prevailing quarter. So you can see on top of the slide how we've been in a way progressing from 40% to 30%, 20%, and now below 20%, and what the equivalent payout would mean as far as dividend is concerned. So yes, so that's the change, and I think one of the more positive ones in terms of shareholder return.
And then you have started a share buyback program, which I also find very interesting, of $100 million.
Yes. So what we have announced is that we will initiate up to $100 million of share buyback, and we will come back with the actual structure at a later stage. And the reason for this is, so we have never really been stuck on dividends versus share buyback as a principle. We have been debating this basically every quarter with the board, but we feel now that with the latest drop in share prices that we've seen across the shipping sectors in general, that the levels that we're looking at for our share price versus how we see the NAV of the company, but also how we see our own expectations of where markets are going, basically means that it makes sense for us to begin looking at buying back shares in addition to paying out the dividend for Q3 that we are doing now.
So let me just summarize. Of course, the share price have taken quite a change in Q3 until now. So you have a NAV of what, $2.7 billion and a market cap of 2.7, and the NAV is much higher. So is this the sort of discussion you've had in the board, is that actually to utilize that situation to buy back shares?
Yeah, exactly. So I think you can always discuss what is the right level, and I think people probably have individual views on this. We know that a lot of our shareholders also like share buyback versus dividends. We try to listen to, obviously, to all of our shareholders, what people think and listen to the arguments. But of course, when we look at an NAV today of Hafnia, which basically, according to us, would be around 100 NOK at the moment, and we've been trading around 60. That gap is simply so big that it makes so much sense for us to go out and buy back shares. And quite frankly, we don't see any reasons why those NAVs and others should change meaningful in the nearby future. So I think at that discount, it makes a lot of sense. Now, we don't have any guaranteed threshold or any pre-agreed thresholds where we would stop doing it, but it's just to illustrate that at 40% discount, then obviously it's a great way of in a way buying assets cheap by buying back your shares.
And just a rough calculation from my side would mean that you would actually buy quite a lot of the daily average volume, say 20%. Is that a fair assumption given what the historical trading have been?
Yeah, that's probably not far from, actually.
No,
that's probably not far from. That's right.
And also given the dividend is approximately the same, so you would have approximately what 25% dividend yield as of this year.
That's correct.
Okay, cool. Because this is there's quite a dramatic change in the share price, and yet a lot of these things is actually this is an opportunity in that case.
Exactly. So I think for us, it's we look at the timing, we look at having had a very strong third quarter that allowed us to pay out, as I said, the $190 million. At the same time, contrary to that, have a very low share price ahead of a winter market that we see unfolding right now. Those two things in combination makes a lot of sense, and in our view, will create a lot of shareholder value.
Cool. And just a follow-up question, because you have actually moved your headquarters to Singapore in this quarter. Has that any relationship to these considerations, and does that impact the shareholders in Hafnia at all?
Yeah, no, not at all. So basically, we moved our holding structure from Bermuda to Singapore, and Bermuda was kind of a legacy thing that came out of, let's say, non-Hafnia related things, really. So by moving it to Singapore, we now have not only our headquarter, but also all our assets owned here, now also the holding company. So it's a proper substance we have here in Singapore, and there will be no change whatsoever to the shareholders. There will be no changes in any form of withholding tax or anything like that. So everything will be the same. It's just a more solid corporate structure than it was before.
Cool. I think that's quite an important point for people to understand, that there's no changes in that. Good. Let's go into the industry review, Mike, because just to set the scene here, of course, the share price have taken a hit because of some of the industry movements. So maybe you could sort of give us an introduction to how you see this situation. Then we can dig into some of the slides. There will also be questions about the winter market, and we'll get to that. Please.
Yes. Yeah, so I think probably the right way to look at the end of this year is to look at Q3 in combination with Q4, because I think what we have seen is that Q3 has been a lot stronger than what we would normally expect, and therefore I think the fact that Q4 started very low from October, November, I think has kind of that gap between the two has created what I call a negative sentiment, and people may be being afraid that the markets were not as strong as what people expected. For us, the reason is relatively simple, is that what we saw by the end of Q3 and what is actually factored into Q4 is that there are a lot of crude vessels that would normally be trading crude oil that cannibalized into the product tanker trade, our trade, which is refined oil, because their own market was very low. So what happens is that you get more ships into the market. They took away probably 6% of ton mile that normally would have come to the standard product tanker fleet, and that's obviously a lot. So what we are facing now, really from October, November, is the consequence of having cannibalization from ship outside coming in and taking cargoes away from our tonnage. But what we're also seeing is that is now running off. Those cargoes have now been delivered in Europe. Traders and oil companies are not inviting these ships in again, because there's been a lot of issues around contamination, and the crude market is also, for the ships that are come into our trade, has also showed more strength than they did in that period. So the way we look at it is that the very weak start was really because of lack of long haul cargoes for the product tanker fleet. That's now going to reverse, as we see now. Loadings are going up as we speak on the ships, and we see inventories going down in Europe. So we are quite convinced that that ton mile that was stolen away from a different sector is now back in our market, and that will make a huge difference on freight earnings.
Cool. Mike, I think that we can just flip through some of the slides here, because there's many slides underlining this point, but maybe you can see a lot of them is pointing downwards towards the end of Q3 and into Q4. And you're talking about a normalization, and basically maybe the key question from one of the audiences is the winter market coming back?
Yeah, and the short answer is yes. And as I said, the real thing to look at when we look at the market from Q3, Q4, Q1 next year, Q2, there is no difference whatsoever in the way we looked at it 3 or 4 quarters ago and as we look at it today. Nothing has changed. There's no more ships coming in. There's nothing changing. There's no demand change. What has changed factually was that we lost 6% ton mile to crude carriers, and that is now being phased off. So because they were taking a lot of the long haul voyages, that also means that most of the product tanker vessels stayed in regions. And what really creates value in the product tanker market is when ships are crossing from one area to another, i.e. loading east of Suez, going west of Suez, longer distances. When ships stays in the area, they have a tendency of oversupplying and put negative pressure. So what we will see now going into the winter market is you're going to see product tankers travel longer with oil again to refill inventories, particularly in Europe. And that in itself will bring back, in our view, freight earnings to where they were.
Okay. I think this is some of the key slides you have chosen to put into your presentation today. Do you want to comment on this one perhaps?
Yeah, so it's really to illustrate what we kind of have seen in terms of winter market trends and trends going onwards, right? And as you can see, for instance, in CPP and chemicals, we are now seeing during the last month that ton mile and volumes for CPP and chemicals is going up on the left side, and what you see on the other side, the right side, is that it's decreasing for dirty petroleum products. So it kind of to indicate what we have seen now is that the ton mile is coming back and the cargo volume is coming back into our product tankers, and whereas it's fading off on the dirty petroleum side.
Okay, and this one is it just stumbled my mind on the right hand side here that it's underperformed quite a lot. The LR earnings is and the ton mile effect has sort of separated. Is that fair? I'm not sure I understand why, but maybe.
Well, I think, yeah, and I understand why you don't understand why, because I think what happens in our markets often is that there's not really that big a difference between $25,000 and $15,000 in earnings per day per ship, other than sentiment. So the markets can be roughly in balance, a little bit below balance, but it doesn't take a lot to push sentiment the wrong way. So often you will see that if there's a strong belief where the market is going a week or 2 weeks ahead, people will hold out. If you are in the middle of, as we have been, a negative sentiment where share prices are dropping, the geopolitical issues are kind of becoming very uncertain. There's a lot of negative sentiment around you. There is a tendency of people not to be so resistant when they're negotiating and holding out for freight rates. So I think the sentiment has definitely increased, if you like, the negative trend versus where it was before. And you look at the share price and you look at people's comments in general, I think there's been a very, very strong vocal view that the freight markets were in for a long, long downturn. And all I can say is that we looked at our data and everything we have, we just don't see anything that supports that other than just a negative sentiment overreaction, putting a negative overreaction into the market.
And that's perhaps illustrated on this one where you sort of try to highlight the difference between fundamentals and sentiment.
Exactly. That's exactly it.
Yeah. Michael, let's take some questions because they're almost all related to the geopolitical situation, and I'm sure you can answer them. So let me just I'll go by them one by one because I think they're all very, very interesting. There's this discussion of a ceasefire between Israel and Hezbollah, and do you see that changing the Red Sea situation in 2025?
Yeah, I don't think it's up to us to have, let's say, a kind of a specific view on when and how that will play out, right? But I think it's obviously clear that when the Suez Canal comes back at some point to normal operation, it will take away some ton mile from the current situation for product tankers. So instead of going via Cape of Good Hope, you're going to go to the Suez Canal. So I think that is a factor that we've already discussed a few times. And in our view, when we look at where freight earnings were before the Red Sea crisis and what they were afterwards, there was probably a 20% difference in terms of earnings. So it wasn't a 50, it wasn't a 60, it was not a collapse. It was more correction, if you like, of those extra 5 to 7% ton mile that will be redirected and lost because the vessel will go shorter distance through the Suez Canal.
And a related, I mean, again, these geopolitical concerns, of course, is very important for you. There's a question on China and, of course, also on a new president in the US. Do you see any implications for Hafnia on those two themes?
Well, I think with China, you can say in general, I mean, obviously China is super important for the world in general in terms of, of growth and activity overall. So, yeah, I don't think anyone's going to do very well if China is completely losing steam. But I think it's important to understand that for product tankers in general, we are not that depending on China in terms of import of oil, etc. So where China is important for us is actually that if China for some reason is consuming less of their refined oil inside China, a lot of that will come out for export, which is actually good for our trade. So China is not a demand-driven area for us as such. It's more of a surplus export of products that they don't use themselves, just to bear that in mind. So, and when it comes to the US, well, I mean, obviously, I think most people will say it's positive with the new statements that are coming from the president-elect. It's difficult to see that's going to be negative for oil in general, because obviously they want to push and drill more, which eventually will mean more export, either of crude oil or of refined oil products. So I think that on an isolated basis should be considered a positive for oil in general, because they want to produce and refine more.
Good. And then there's actually a question on let me just double check here. The capacity in terms of scrap versus new build, and do you experience any net adds from crude segments? I think we have a slide on this in particular. This I guess is what's been asking about the aging fleet, and also how do you think the order book is developing as we speak?
Yeah. So I think this slide here, as you see on the left side, is kind of very good. Here we've combined the clean and the crude tanker order book, because there's a lot of moving across from one to the other depending on kind of what is needed. So as you can see here, basically the tanker order book today, which is the orange graph going up, is still way below the scrapping, expected scrapping for the tanker segment overall. And I think the average scrapping age for these graphs are around 23 years, which is the current average scrapping age of tankers in general. So if you then look at what is aging above 15 years and above 20 years, which means that within the next 3 to 4, 5 years, also will come into that bracket, it just shows again that from a longer term perspective, and I've said this before, even if we build more product tankers and start filling up the order book from 28, 29, we're simply not going to be able to cover the shortfall of tankers if oil demand just stays flat for the next, say, 5, 7, 8 years out there. Because we have, and if you go to the other slide, to the one with the fleet on as well, I think it's one of the later ones. Go
this
forward.
One?
No, the one where they have that's the one. So if you look at the right side here, the historical new builds, i.e. that is a good graph that shows when ships were built. You can see from 2004 to 2010, 11, that's where the bulk of the ships are. All of these ships will hit scrapping within the next up to 5 years. So we're going to be short of so many ships in general if oil demand just stays flat. So I think are we going to have a period where there will be new ships delivered before scrapping takes place? That may happen a few years out, but fundamentally, there's no doubt that we will be shorter vessels on the longer term, even if we started ordering more ships.
Cool. And let me just double check if there's anything I missed here. That's perhaps also a question that there's one in the audience who claims there's not that many trades on ships as we speak. So obviously the question goes on to the value of your NAV longer term, because if you don't trade ships, do you see? I think I'll rephrase it. Do you see any reason to suspect that NAV will come down significantly?
Yeah, so I think that's a really good question, and it's also correct, right? That basically what you're seeing is when sentiment as it is now has been down, what we basically see typically in our market is that, when you come from a very high level of pricing, a very high level of time charter rates, people get afraid of taking long-term commitments because they want to see, just like shareholders actually, spot market improving, and that this was not a permanent trend, but rather a seasonal fluctuation. So because we had so high prices on second-hand ships and new builds, it is true that transactions have come down. I think what's interesting to compare it to, and people on this call here can go and have a look at that as well, is the dry bulk market also had a couple of really, really strong years where people made obviously a lot of money. And if you look at what happened to the asset prices afterwards, is that freight earnings dropped and stayed low for a long time, but asset prices never came down. And the reason for that is that people have made enough money that they didn't have any distressed sale. They could hold on to their asset and say, well, if I'm going to drop that much in price, I'd rather just keep it and trade it myself. And I think for tankers, you're probably going to see some of the same. We can sense the standstill that sellers of assets today are not reducing their prices to reflect the current trade earnings. They're staying up where it is, and buyers are not willing to step up and pay that price now. And therefore, I think the question raised is right. I think we're going to see fewer transactions, fewer data points. But I don't think you're going to see asset prices drop significantly on the back of that, but probably a smaller swing is probably what's going to be the result.
Cool. And then there's a lot of questions on the industry side, so I'll just take them, Michael. The dark fleet, do you see that eating more and more market share from the compliant fleet, or how do you see this situation?
No, we see it pretty stable at the moment, actually. So I think we are counting, when you say dark fleet, and here we include also ships that are trading Venezuelan, Iranian oil, etc. It's probably about 1,100-1,200 tankers altogether today that would have problems coming back. Out of those, our view is probably that if all sanctions were being lifted and everything was kind of back to normal, if theoretically, probably out of those, our view is that maybe 200 to 300 ships could come back to normal trade. And this is about quality, age, owners of those ships. The rest of those ships, in our view, will not come back again. And I think those ships, both age-wise and quality-wise, are in such a bad shape that it will be, almost impossible to bring them back into global trade again.
Cool. Let's leave the industry section. It's very, very interesting, but and I guess very important. Is there anything on the financial summary looking back you want to state here on the perhaps also the rest of Q4?
Nothing else than really say that for us it's been super important that we link the dividend policy, as I mentioned, to the balance sheet. I think one of the successes of Hafnia has been that we have been buying and expanding when markets have been low, and we've been harvesting when markets are high. And I think one of the things to prepare for is now to make sure that you continue to have a strong balance sheet, so that when markets at some point, for whatever reason, drops and opportunities come up, that we can act when other people may be finding it more difficult to act. So I think it's important that we keep those two things in check, and we'll continue to manage the proper balance sheet as we still pay out dividend to our shareholders.
Cool. And this is going into this robust financial strength you're describing on your balance sheet. Is there anything on LTV is 19.1, lowest ever, I guess. Yeah.
Well, the only thing I would say is that, so our ambition is not to bring our debt down to zero. So we don't think it's an efficient use of capital, to have a company like this that is so asset heavy, to be pure equity financed. So there will be a time where we will feel that the debt is at a level where we are happy with it, and at that point, just will focus on distributing net profit to shareholders. That's the idea. We have access to about 30 banks that have been actively involved in Hafnia, and we have extremely good terms, and we want to make sure that we keep an element of debt that gives a good weighted balanced capital structure, but also allows us to have access to capital through bank debt should that become an opportunity going forward where that is needed.
Cool. Can you, this is illustrating one of the key points that we have been discussing about your considerations as to share buyback. And I find this relatively interesting because this is a reflection of the assumed pricing of the stock market into your fleet. Maybe you can put some words onto this.
Yeah, and what's interesting is actually, and this graph reflects like real discussions in the company, right? That you have your asset management team coming up and saying, we can get this 5-year-old vessel at this price, and it's still cheaper than it was 2 weeks ago. It should be interesting, etc., etc. So you have this conversation, and you kind of reverse the discussion to say, well, what really gives most value for the company? We have 130 ships. We're not going to change materially by buying another ship at elevated value, but buying back shares actually allows us to buy back equivalent type of asset below the historical average. So one thing is that it's cheaper, but it's actually below historical average. Looking into a supply-demand scenario that we are going forward, I mean, that's quite a unique opportunity, quite frankly.
Cool. The rest of the year, your coverage rates and stuff like that, is there anything you want to remark?
No, the only thing I would say, and I think for people to bear in mind, is that when you look at the fourth quarter isolated, it is true that it looks a lot lower than what we've seen other years. I was telling you earlier, I think you should look at Q4 in connection with Q3. We made more than 200 million for Q3, which is an exorbitant number for a so-called summer period. So I'd like to think when you look at these numbers more as a movement, for the reason I mentioned about crew carriers taking our cargoes in Q3, being the reason why it's been pushed into Q4. In a normal situation, probably we would have made 150 million in Q3, and the drop to Q4 would be less or maybe the same level, and most likely our share price would be a lot higher, despite the fact that we would make less money on absolute terms. So I think that the gap between Q3 and Q4 is giving the wrong sentiment. What it really is, it's more a movement of earnings from Q3 or lack of same into Q4, rather than it is a result of a changing market fundamental.
Cool. If there's any more questions, now is the time, because we are going to finish off pretty soon. Is there anything on the ESG side you want to comment? It's obviously a big theme in shipping these days and everywhere, by the way.
So I think we are well advanced on all these 3 areas, and it's something that's it's an integral part of the way that we run the organizations. And I'm particularly happy to say that on the social part, having run these culture labs on our ships, trying to improve the psychological working environment on board ships by adding diversity into the crew composition, is already showing great signs. So my hope is that the industry as such would move forward and create more diversity at sea, which will open up for the industry being more attractive to everyone out there, as opposed to at the moment having isolated talent pools to recruit from. So that's one area where I think hopefully we can help pushing the industry in the right direction.
Cool. By that, I think we'll say thank you very much, Michael, for your attendance, and thank you very much to the audience for your questions. I hope you have them answered. And if you have any more questions, please send them to us or to the investors site on Hafnia. Thank you very much for today.
Thank you.